0.5%. That's how much the dollar just jumped against the Swiss franc, hitting 0.8890. Most people scroll past a number like that. But for Kenji Yamamoto, a senior forex strategist at one of Tokyo's largest trading firms, that 0.5% move just changed everything about his morning. It's 6 a.m. in Tokyo's financial district. The city is barely waking up, but Kenji has already been at his desk for an hour, watching the European session close and the early Asian liquidity pools form. His screens flash with currency pairs, but his eyes keep returning to one number, the dollar-Swiss franc cross rate. Now here's what you need to understand. In the world of institutional forex trading, a 0.5% move isn't small. It's not even medium. For a trader managing billions in currency exposure, that kind of swing can mean the difference between a stellar quarter and a career-ending loss. And when the world's most stable safe haven currency, the Swiss franc, suddenly weakens this dramatically against the dollar, it sends ripples through every other currency pair on the planet, including the Japanese yen. In this video, you'll discover 3 critical things. First, why this dollar surge is actually a warning signal that most analysts are completely missing. Second, the hidden mechanism connecting Swiss franc movements to Japan's economic future. And third, what this means for anyone holding yen-denominated assets or investing in Japanese markets. The connection between these currencies runs deeper than almost anyone realizes, and by the end of this breakdown, you'll see the global forex chessboard in an entirely new way. Here's the problem Kenji faces every single day, and it's a problem that's getting exponentially worse. The traditional correlations that forex traders relied on for decades are breaking down fast. For 30 years, the Swiss franc and Japanese yen moved in tandem during global uncertainty. Both were considered safe haven currencies. When markets panicked, money flowed into both. When risk appetite returned, both weakened together. This correlation was so reliable that traders built entire algorithmic systems around it. But in the past 18 months, something fundamental has shifted. The Swiss National Bank and the Bank of Japan have diverged in ways nobody predicted. While Switzerland has aggressively raised rates to combat inflation, Japan has stubbornly maintained its ultra-loose monetary policy. The result? A complete decoupling of two currencies that used to dance in perfect synchronization. Now the dollar jumping to 0.8890 against the franc isn't just a data point. It's a symptom of a much larger problem. When the dollar strengthens this dramatically against one safe haven currency, it typically applies similar pressure to others. Yet the yen's reaction has been muted, creating what traders call a dangerous divergence. Kenji's screens show him something troubling. The implied volatility on yen options is spiking while actual realized volatility remains compressed. In trader terms, this means the market is pricing in a massive move, but nobody knows which direction it's coming from. It's like watching a coiled spring, knowing it will release violently, but having no idea when or where the energy will go. But here's what most people don't realize. This dollar surge against the franc isn't really about Switzerland at all. It's about something happening thousands of miles away in Washington, D.C., and its shadow is falling directly on Tokyo. The Federal Reserve's hawkish stance has created what currency strategists call a yield vacuum. When U.S. Treasury yields climb above 4.5%, while Japanese government bonds hover near zero, the interest rate differential becomes almost irresistible for institutional money. Capital doesn't have feelings. It flows toward higher returns like water flowing downhill. Now, the Swiss National Bank tried to fight this dynamic by raising their own rates aggressively. For a while, it worked. The franc held relatively strong against the dollar through most of last year. But even Switzerland's famous financial discipline has limits. When America offers yields that high with dollar stability, eventually even Swiss institutional money starts crossing the Atlantic. That's what caused this 0.5% jump. Not some dramatic policy announcement or geopolitical crisis. Just the relentless, grinding pressure of yield differentials finally reaching a breaking point. For Japan, this creates an almost impossible situation. The Bank of Japan has signaled repeatedly that it cannot and will not match American rates. Governor Ueda has made clear that Japan's economic recovery is too fragile, its debt load too enormous, to risk aggressive tightening. This means the same forces crushing the franc are poised to accelerate yen weakness. And unlike Switzerland, Japan doesn't have the same room to maneuver. And here's where the story goes from being about one Tokyo trader to being about everyone watching this video. Kenji's problem isn't unique. It's not even particularly Japanese. This pattern is hitting traders, investors, and businesses in every major financial center on Earth. In London, pound-dollar traders are facing the same yield pressure dynamics. The Bank of England, like the BOJ, is trapped between fighting domestic inflation and preventing currency collapse. In Singapore, traders managing Asia-Pacific portfolios are watching the yuan wobble under identical forces. In Sydney, the Australian dollar's commodity-linked swings have become almost unpredictable. The common pattern is this: American monetary dominance is creating a world where every other central bank is essentially forced to react to Federal Reserve decisions rather than domestic economic conditions. When the Fed stayed dovish, everyone had breathing room. Now that America has chosen aggressive tightening to crush inflation, every other currency is paying the price. For individual investors, this matters enormously. If you hold any international assets, Japanese stocks, European bonds, emerging market funds, you're exposed to these currency dynamics whether you realize it or not. A 10% gain in the Nikkei 225 means nothing if the yen depreciates 15% against your home currency. That's not hypothetical. That's exactly what happened to many foreign investors in Japanese equities over the past 2 years. The traders who survive this environment are the ones who stop seeing currencies as pairs and start seeing them as a global web of interconnected pressures. But here's where Kenji's thinking shifted, and it changed everything about how he approaches these markets. For years, he'd been trying to predict which way currencies would move. Long yen, short dollar. Long franc, short euro. The conventional approach. And for years, it worked reasonably well. But watching the dollar-franc surge to 0.8890, something clicked. He stopped trying to predict direction and started focusing entirely on volatility positioning. Because here's what most retail investors miss. In currency markets, you don't have to be right about direction to profit. You just have to be right about the magnitude of moves. The options market was telling him something crucial. Implied volatility on yen options was trading at a significant premium to historical realized volatility. In plain English, this means options traders were paying excessive premiums for protection against big moves that hadn't materialized yet. But that dollar-franc surge was a signal. The coiled spring was starting to release. Instead of betting on yen strengthening or weakening, Kenji repositioned entirely into volatility strategies. Straddles and strangles that would profit regardless of direction, as long as the move was big enough. And crucially, he structured these positions to decay slowly enough that he could wait for the inevitable eruption. This isn't about being smarter than the market. It's about recognizing that in a world of unprecedented central bank divergence, the old directional playbook no longer applies. The new edge comes from understanding that uncertainty itself has become the trade. So what did this actually look like in practice? Let me walk you through the concrete changes Kenji implemented, because this is where theory becomes actionable. First, he reduced his directional currency exposure by roughly 40%. Instead of holding large naked positions betting on yen weakness or dollar strength, he shifted that capital into delta-neutral strategies that would profit from large moves in either direction. This doesn't mean he has no opinion on where currencies are headed. He still believes the yen faces structural weakness, but he's no longer betting his entire book on being right about timing. Second, he dramatically increased his allocation to cross-currency volatility plays. Rather than just trading dollar-yen, he's now actively trading the relationships between multiple pairs. The dollar-franc surge created ripples in euro-yen, pound-franc, and Aussie-yen crosses. By spreading positions across these relationships, he captures the systemic volatility rather than relying on one pair to move exactly as predicted. Third, and this is crucial for retail investors, he shortened his time horizon significantly. In the old regime, you could hold currency positions for months and let fundamentals play out. Today, with central banks capable of surprising markets with intervention at any moment, he rarely holds positions longer than 2 weeks. The Bank of Japan's surprise yield curve control adjustment in July 2023 taught him that lesson the expensive way. Finally, he built systematic hedges into every position from day one. No naked exposure. Every trade has defined risk parameters before it's executed. In a market where 0.5% overnight moves have become routine, this discipline is non-negotiable. 3 months after implementing these changes, the results told the story clearly. Kenji's volatility-focused approach didn't just protect him during turbulent periods, it actively profited from them. When the yen suddenly surged 2% in a single session after suspected Bank of Japan intervention, his straddle positions captured that move while directional traders scrambled to cover losses. When the dollar-franc pair reversed half its gains the following week, his cross-currency positions absorbed the shock without significant drawdown. Most importantly, his risk-adjusted returns improved dramatically. In trading, it's not just about how much you make. It's about how much risk you took to make it. By focusing on volatility rather than direction, Kenji reduced his maximum drawdown by nearly 35% while maintaining comparable absolute returns. In professional terms, his Sharpe ratio climbed significantly. But here's what really changed: his stress levels. And this matters more than most people admit. When you're positioned for volatility rather than direction, overnight news stops being terrifying. Central bank surprises stop being portfolio killers. You can actually sleep, knowing that your positions are designed to benefit from uncertainty rather than be destroyed by it. The dollar surged to 0.8890 against the franc wasn't a crisis for Kenji anymore. It was exactly the kind of market dislocation his new approach was built to capture. While others panicked and tried to figure out what it meant, he was already profiting from the fact that it happened at all. That's the power of adapting your strategy to market reality rather than fighting the conditions you wish existed. So here's the question you need to ask yourself. How exposed are you to currency movements you've never consciously chosen? If you own international stocks, foreign bonds, or even U.S. companies with significant overseas revenue, currency dynamics are affecting your returns every single day. That dollar surge against the franc wasn't just news for professional traders. It was a signal about global capital flows that impacts everything from Japanese stock valuations to emerging market debt prices. You don't need to become a forex trader to protect yourself, but you do need to understand that ignoring currency exposure doesn't make it go away. Consider these questions for your own portfolio. First, do you know what percentage of your holdings are effectively denominated in currencies other than your home currency? Most people don't, and the answer often surprises them. Second, have you stress-tested your portfolio against major currency moves? A 15% yen depreciation, a 20% euro surge, a dollar collapse scenario? If the answer is no, you're essentially flying blind through one of the most volatile currency environments in decades. Third, and this is the most important question, is your investment strategy built for the world as it is, or the world as it was 5 years ago? Because the rules have fundamentally changed. Central bank divergence, yield differential pressures, and safe haven decoupling aren't temporary phenomena. This is the new regime. The traders who thrive from here won't be the ones with the best predictions. They'll be the ones who built portfolios that profit from uncertainty itself. That dollar jump to 0.8890 francs was just the latest chapter in a much longer story. The question is whether you'll be prepared for the next one.